Gold's story in America in 2025 and beyond reads like a plot twist in the history of money, something long seen as an investment vehicle, a store of value, or an ancient relic of monetary systems past, is suddenly re-emerging in multiple arenas as something that looks, feels, and, in some contexts, legally functions like money again, and Americans are paying attention in ways they haven't in decades. At the same time that states like Florida and Texas are moving to recognize gold and silver as legal tender under state law, gold prices have been smashing records, surging past $4,500 per ounce in late December 2025 in one of the most dramatic year-end rallies in modern financial history, driven by safe haven demand, expectations of further Federal Reserve rate cuts, geopolitical instability, and a softer US dollar, underscoring how deeply investor sentiment has shifted toward the yellow metal as a haven amid economic and policy uncertainty. In this narrative of gold's return to money, it's worth beginning with the headlines. Reuters reported gold hitting record highs on safe haven demand and Fed rate cut bets just days before year's end, with spot gold climbing to $4,501.44. After hitting all-time peaks as the U.S. economy navigated complex headwinds, from inflation pressures to political dysfunction. Meanwhile, state legislatures across the U.S., including Florida, Missouri, Oklahoma, and Texas, are passing bipartisan sound money bills designed to make it easier for citizens to hold and use gold and silver in everyday commerce, with Florida Governor Ron DeSantis signing legislation to recognize gold and silver coins as legal tender, and other states crafting frameworks that could allow gold-based electronic payments. For many Americans, these developments represent more than abstract policy shifts. They signal a deepening skepticism about fiat currency, a yearning for financial sovereignty, and a belief that real money, defined by intrinsic value and centuries-long trust, is making a comeback in public life. But to understand this movement, you have to place it in the broader macro and monetary context of 2025 and beyond. Gold's price trajectory this year has not been a gentle climb but a historic, record-breaking rally, with the metal benefiting from a confluence of factors that very few mainstream analysts foresaw just a few years ago. Safe haven demand surged as global trade tensions, tariff uncertainty, and U.S. political battles over debt ceilings and government funding created waves of market anxiety, pushing investors into gold as a hedge. Even major financial institutions raised forecasts for gold's future. Bank of America raised its 2026 gold price forecast to $5,000 per ounce, while others projected prices above $5,200 by the end of 2026, reflecting bullish expectations that gold's structural demand drivers would remain strong. This resilient price performance transformed the perception of gold from a passive hedge to an active macro asset, one that moves boldly with shifts in monetary policy expectations, debt dynamics, and global reserve strategies. At the same time, U.S. monetary policy developments, particularly the Federal Reserve's decision in 2025 to cut interest rates multiple times to a range around 3.5 to 3.75%, have had a profound impact on gold's allure, as lower interest rates reduce the opportunity cost of holding non-yielding assets like gold, Alongside this, the dollar's weakening, a trend that has been cited in multiple financial analyses and which some commentators cite as shifts in U.S. trade and fiscal policy, has further amplified gold's relative appeal. Although Federal Reserve officials have stated that gold's surge doesn't necessarily mean the world is abandoning the U.S. dollar as the global reserve currency, they also acknowledge that private investor demand is a major force behind gold's pricing and inflows. This nuance is critical. Gold's rise doesn't automatically equate to a collapse of the dollar or an abrupt return to the gold standard, but it does reflect a rebalancing of confidence and a hedging strategy against macroeconomic risks perceived by investors. Concurrently, a major regulatory shift under the Basel III banking reforms implemented in the U.S. on July 1, 2025, has elevated gold's status within the banking system by classifying it as a Tier 1 high-quality liquid asset, meaning banks can now count physical gold at full market value toward their core capital reserves, substantial upgrade from previous rules that heavily discounted gold's regulatory value. This change effectively restores gold to a position of prominence within financial institutions' balance sheets, enhancing its liquidity and systemic importance and validating what many in the markets have long argued. That gold is not just an ancillary commodity, but a strategic asset integral to financial stability. That Basel III upgrade has been widely discussed in investor communities and among financial analysts as a signal that institutional frameworks are now formally recognizing gold's monetary characteristics. While the national government under the U.S. Constitution retains exclusive authority over federal currency, these state-level legal tender initiatives are rooted in a resurgence of sound money sentiment. Section 10 of the U.S. Constitution, which prohibits states from making anything other than gold and silver coin a tender in payment of debts. Some lawmakers and advocates view this as an overdue reaffirmation of constitutional principles in a world where fiat money's purchasing power has been eroded by persistent inflation and expansive fiscal policies. In practical terms, these laws don't force businesses to accept gold or silver. Acceptance remains voluntary, but they do remove barriers such as sales taxes and regulatory uncertainty, and foster infrastructure including electronic payment systems that would enable holders of precious metals to spend them more easily, potentially even for everyday transactions like rent or groceries. In Florida, for example, House Bill 7031 removed the minimum purchase requirement for sales tax exemptions on gold and silver bullion, making bullion more accessible to smaller investors. And House Bill 999 was signed into law to recognize gold and silver coins as legal tender, with full implementation expected by mid-2026 pending administrative rulemaking. Similarly, Texas passed laws designating gold and silver as legal tender starting in 2027, with systems linking bullion to digital payment platforms, enabling transactions without obligating physical hand-to-hand gold exchange. These legislative moves have been interpreted by proponents as a way for states to offer financial alternatives and hedges for their citizens. In a macro environment where trust in fiat currency is under scrutiny across the broader national conversation, the debate about returning to a formal gold standard where the US dollar would be directly redeemable for a fixed amount of gold remains intense. deeply rooted in historical monetary discussions and economic theory. Encyclopedic and expert sources note that the United States formally abandoned the gold standard in the early 20th century, especially with the Gold Standard Act of 1900, establishing gold as the monetary standard, and later developments fully removing that link by 1971, leaving the U.S. on a fiat system. Today, the gold standard debate has re-emerged in some academic and political circles, with proponents arguing that a gold-backed currency could limit inflation and government overreach, while critics warn that such a system could constrain monetary policy flexibility and harm economic responsiveness. Concerns explored in recent discussions about monetary policy and fiscal sovereignty. However, the modern gold is money again narrative is not primarily about a rigid gold standard. It's about functional monetary relevance, anchored both in markets and in evolving legal frameworks. From an investor psychology perspective, which is central to understanding why gold's story resonates so strongly with American audiences today, there's a clear shift from viewing gold as merely a passive hedge against risk to seeing it as a core component of diversified portfolios and a marker of macro risk sentiment throughout 2025. Gold attracted record inflows into gold-backed exchange-traded funds, ETFs, and physical bullion markets, underscoring that demand is not confined to retail speculators, but is supported by institutional investors, central banks, and sovereign reserve managers alike. Institutional forecasts that put gold prices above $5,000 per ounce in the coming year reinforce markets' perception that structural demand is strong and that gold's role is evolving beyond the traditional safe haven label into something that reflects broader economic expectations about inflation, currency, stability, and geopolitical risk. American households, retirees, and Main Street investors are reacting to these developments not in isolation but in concert with what they see in daily headlines. Record price rallies in gold, legislative action in their states, and debates over monetary policy in Washington, D.C., when gold prices repeatedly hit fresh all-time highs. Whether approaching $4,500 Oz or trending toward $5,000 Oz territory, it doesn't feel like an abstract macro phenomenon. It feels like a validation of deep concerns about purchasing power, financial security, and the role of government in shaping money. That emotional and psychological component is crucial. For many Americans, gold's resurgence is not just a financial opportunity. It's a symbol of monetary resilience and a hedge against uncertainties that fiat currencies alone can't always mitigate. Critics and skeptics are quick to remind audiences that gold's price surge doesn't automatically signal the demise of the US dollar or an imminent national return to the gold standard. And Federal Reserve officials have reiterated that gold's rally primarily reflects private investor behavior rather than an official shift in reserve allocations away from the dollar. Indeed, U.S. dollar dominance remains entrenched globally, and the Fed continues to manage monetary policy based on inflation and employment goals rather than commodity-backed frameworks. Still, even acknowledging this mainstream perspective does not diminish the palpable shift in how millions of Americans think about money. What was once a fringe topic for gold enthusiasts has moved into the mainstream discourse, fueled by tangible price action, legislative experiments, and macroeconomic developments that have made gold's trajectory impossible for investors, policymakers, and citizens to ignore. In this landscape, gold's transformation into something that feels like money again in the US is neither a simple reprise of the past nor a sudden revolution. It is a gradual, multifaceted phenomena encompassing market psychology, legal experimentation, regulatory and economic uncertainty. Whether states' legal tender laws will materially change everyday commerce remains to be seen, and whether gold will continue its upward price trajectory as forecasted by major financial institutions depends on future interest rate decisions, geopolitical developments, and global economic performance. Yet, the underlying narrative that gold's relevance is deepening, that it is re-entering conversations about money, and that Americans are increasingly attentive to its role as both a store of value and a potential medium of exchange is unmistakable. So when you hear commentators, analysts, and policymakers say that gold is becoming money again, what they are capturing is not some instant reversion to a bygone monetary system, nor a simplistic slogan divorced from economic reality. What's happening is far richer, far more complex, and increasingly grounded in real-world price action, legislative innovation, financial regulation, and investor sentiment. Gold today stands at the nexus of monetary theory, practical finance, and political expression, and for many in the United States, that fusion feels very much like gold has become money again in the modern era.